In this presentation, we will discuss how we can deal with loans and loan payments within our bookkeeping system within QuickBooks. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We'll discuss 3 options that we can use for a bookkeeping system related to loans and loan payments. Remember that the loan payments that we see are only going to be the things that are going to affect the bank statement, because that's what we're using under this system in order to create the books. If the company takes out a loan then, and they deposit money into the checking account because they took out a loan and got money and put it into the checking account, then we would see that money in the checking account and we would have to record the increase in the checking account and the other side to the loan. However, it's possible that a company finances something as well, like a purchase of equipment, and then they finance it and we never see anything hit the bank statement because they didn't pay for the equipment in that case, and we don't have the amounts for the loan didn't go into the checking account. In that circumstance, the only time we'll actually see the loan through the bank statement is when the payments happen. At that point in time, if that were the case, when the payments happen, then we want to ask about it and say, what is this payment? Who is this for? Is it a loan? Okay, it's a loan. Then we may not even want to set up the loan documentation and plan on that to be done at the end of the year, but rather just enter the entire payment as a liability account. So it's a loan payable, and that'll actually make a negative liability account. So it will look funny on the balance sheet if we don't record the actual loan and we start making payments into a liability type of account. Why would we do that? Because we don't want to put it on the income statement as an expense, and we can also just allow the year-end accounting process, the adjusting entry process, then to record the loan and or break out the interest and principal portion at year-end, and that'll make it easy for us to record the information and make an easy adjustment process at the end of the year for any tax preparation or whatever the needs may be at that time. Our other option is to record the loan on the books and then still record all of the payment to the reduction of the loan. So in other words, if we took out a loan, we would record the amount that went into the checking account for the loan, and we would record the loan payable on the books. If they financed the equipment or something like that, we can then ask for the financing and make that journal entry appropriately, meaning we'll put both the equipment on the books and the loan on the books. And then we can then have the payments. We'll have the same issue with the payments, however. There's 2 portions of the payment. One's going to be a reduction in the principal and the other's going to be interest on the loan. So we can still put the whole payment to a reduction of the loan balance, and that's not exactly proper because some of it will be interest. But again, our goal then would be to allow the accountant at the end of the year to make the adjusting entry. Why is that an easier thing to do, you might ask? Note that if we break out the interest and principal, we're going to have a journal entry or a transaction that has 3 accounts rather than our normal 2 accounts. Also, most of the times we have an installment payment if it's a financing type loan for equipment. And installment payments have a separate amount of interest and principal. We'll take a look at an example of this. And therefore, every time we make a payment, even though the payment's the same, the amount applied to interest and principal will differ. So, and also we oftentimes don't have an amortization table from the loan documents. The loan documents don't tell us how much of interest and principal per payment, and we would have to then make an amortization table to do that. So to get around all that, we can just say, okay, the accountant will do that at the end of the year if we need that done, which we should have it at least for taxes to break out the interest portion. We're just going to put on the books right now it as a reduction to the balance sheet account and allow for that adjustment entry at the end of the year. The third option is basically to do the full service type of loan service here, which would be to record the loan on the books at the proper amount. We may actually ask the accountant for these kind of rare transactions because a loan shouldn't happen too often. If we take a loan out, it's not something that happens every day within a business. It's not like sales happening every day. And if we finance equipment, again, that doesn't happen every day. So when it does happen, we can ask the accountant to help us with the transaction to enter the loan. And we may ask the accountant, hey, could you just make an amortization table based on this loan? If you do so, then we'll take that amortization table and we will record the loan payments appropriately, allocating the interest and principal portion as the loan payments happen. And then at the end of the year, it shouldn't need any adjustment. It should be okay and good to go. Now, from my experience as someone who, if I'm checking the loans at the end of the year, if we're doing financial accounting, I tend to find that you end up having to check the loans anyways. So if that's the case, if we're doing financial accounting at the end of the year and you have somebody that's going to check the loans anyways to make the financial statements, then it might be just easier just to let them break out the interest and principal and make the amortization table at that time. If, however, you're dealing with just a tax preparer at the end of the year who may not even, take the time to look through the loan payments and see any adjusting entries, that's just basically going to take our income statement and put it into the tax return, then we want to make sure that we get that interest in there somehow, some way. So that's one reason it's important to know who you're working with at the end and work with somebody that you can set up a system like this to break up some of these entries and give you help for just those adjusting entries at the end of the time period. For more accounting information and accounting courses, visit our website at accountinginstruction.info.